What's up, you guys? It's Henry here. As you can tell by the title today, we're discussing the best value stocks, especially since the Buffett indicator is very high right now, signaling stocks are pricey, and growth stocks are double the PE of value stocks right now. I'm excited for this video because I had a value investing strategy for years, and that's pretty much all they taught me in my finance degree. So here's what you can expect in this video and why it's so important for you to watch through. Number one, why be a value investor? Number two, what are value stocks? And number three excellent value stocks, which I suspect you guys will not want to miss. And lastly, if you watch through my video for the YouTube algorithm, I'm going to throw you guys some information that will help you learn how to fish rather than me giving you guys the stocks that I really like. That way, I'm not only guiding you guys to success, but teaching everyone how to be independent stock market thinkers yourselves. Are you ready, intelligent investors? Let's get into it and let's get stupid rich. Here's what I learned about value investing and why you might want to be a value investor. Imagine you see a brand new Apple iPhone for sale at a store in the box for $500. You quickly check your phone and notice on eBay or Amazon, the same iPhone is going for $1,000. What would you do? If you have the idea to buy the iPhone for $500 and then flip it on eBay and double your money, you already know why being a value investor is a good idea. You can do the same thing with stocks. So what are value stocks and how do I get my hands on them? They are publicly traded companies trading for relatively cheap valuations. Here's one important concept for all investors to understand. Most stocks are generally classified as either value stocks or growth stocks. Generally speaking, stocks that trade for valuations below that of the average of the S&P 500 are considered value stocks, while stocks that are above average growth rates are considered growth stocks. Some stocks have both attributes or fit somewhere in between, and those we will call stonks. Just kidding, you can classify them into one category depending on your criteria, which I will get to towards the end of this video. Value stocks generally have some common characteristics. They typically are mature businesses that have very solid cash flow. They have steady but not spectacular growth rates and usually pay very nice dividends. They have stable revenues and earnings because they've been in the game for a very long time. Some stocks clearly fit into one category or the other. For example, 128-year-old Coca-Cola has grown earnings by 3.5% over the last 14 years, according to my Excel math. While fast-moving Tesla is an obvious example of a growth stock that has 50% growth rates with multiple years ahead that aren't likely to slow down anytime soon. On the other hand, some stocks can fit into either category. For example, there's a case to be made that Apple is somewhere in the middle. I made a video on Apple stock split and whipped out Excel to teach you guys how to project the dividend. Well, the dividend is growing, but clearly Apple can't grow as fast as Tesla because they have massive success and large cash flow. So how much more can you grow when you have a really large base? It gets harder and harder the larger you get. So generally, to summarize, before I move into my favorite value stocks, a value stock is usually a large, stable business and has great, should I say, phenomenal cash flow and pays really good dividends. Now for my top 3 dividend stocks to help protect your portfolio when growth and value start to shift and mean revert. Mean revert means that stocks up here, another stocks right here, they're gonna mean revert and kind of meet in the middle. When things get expensive, they come down. When things get cheap, they come up. Mean reverting just means there's a baseline for value and it always comes back to that value. For example, I weigh about 180 pounds, 180. If I start eating a bunch of cakes, cookies, chips, burritos with extra guac, and all kinds of, you know what, lots of food, I can hit 190 pounds, right? But as soon as I eat normally, my weight will come back down to where it should be, which is around 180 pounds. The same goes for stocks. They come down to where they should be. Number 1, I like JP Chase. Here is some details on the company. As I suspect, I don't really have to make an introduction into what JP Chase does. The company is currently worth over $300 billion, has a PE of about 13, which is less than half of the S&P 500, 29 multiple. The dividend is hard to beat at 3.5%, and estimated stock price in a year is $115 per share. When you look at the 1-year chart, this stock is beaten down, but the brand, the loyal customer, and pretty much the whole business is still really strong and it's definitely there. Plus, banks are too big to fail. So worst comes to worst, you know JP Morgan will be bailed out by the government. CEO Jamie Dimon is a fantastic leader and has some innovative ideas for the bank, and he's really implementing a lot of new stuff. They're even launching their own digital coin. So this stock is likely to do very well and has a lot of support towards that $90 price area. This is a stock that I own and have had for some time now. Number 2, consumer giant and drug manufacturer Johnson & Johnson is next on my list. 1 hour drive from where I live on the East Coast, and under New York City, we have the healthcare giant. It's almost topping $400 billion in market cap and has a 26 PE and pays 2.75% in dividends. All right, I have to look scientific for this because I'm about to be talking about the scientific chief executive officer, or the chief scientific officer, who has publicly stated that he will develop a COVID-19 vaccine. Looking at their balance sheet, they have $19 billion worth of cash, so you can expect the dividend to continue growing and the company having very little issues paying their shareholders. Johnson & Johnson is one of the best blue chip stocks. That's because, similar to the next stock on my list, their products are used worldwide and are essential to the health of the customers that purchase their multiple products. Here's just 9 of the top products Johnson & Johnson sells. I bet you that you come in contact with at least one of these, or you know someone who does come in contact with one of these. That means Johnson & Johnson will have customers for a long time to come, and the stock has nowhere to go but up. Here's number 3 on my list. Do any of these brands look familiar to you? Count how many you know. Well, Procter & Gamble owns all of them. The sector they are in, consumer defensive, even speaks about the safety and value of this company. They are the leader in household and personal products. Their products can be found worldwide, and to mention 5 of their segments, we have beauty, grooming, healthcare, fabric and home care, and baby, feminine and family care. No, it's supposed to be 5. This stock is worth just $20 billion more than JP Morgan and has a 27 PE ratio. So yes, the PE is just slightly under the S&P 500, 29 multiple, but there is something particular that I like about Procter & Gamble. And that's that they beat earnings per share estimates on July 30, extending its winning streak to 21 consecutive quarters in a row. So although the stock would fall in the middle category, I think it's a great addition to those of you that want to be in the safe sector, but not completely give up growth. Before I go into how to find your own value stocks so you can run with the information I give, make money with it, I want to mention a few notable stocks because there is so many obvious choices that I kind of couldn't fit into one video. And those names are Coca-Cola, of course, because of their long history, easy business model, and high profits. Not to mention Warren Buffett's darling. Next, and speaking of Warren Buffett, we have Berkshire Hathaway. Warren Buffett's investment vehicle holds many top stocks like Apple, Bank of America, Visa, and many more. I'm going to link a couple cool books I think are good reads on value investing for you guys, and I have read them myself back in the day when I was obsessed with reading every single finance book and getting my degree from Drexel. It also helps the channel when you use those Amazon links. Next, AT&T, which is a favorite amongst many people. Some of you safe investors called me through my coaching link, and I've noticed a lot of people like AT&T. I think it's a great company because we all have smartphones and we need service, and this company pays a Hold on a second. A mind-blowing 6.89% dividend. How can that even be possible? Now, usually I'm skeptical of such high dividends, but after I've done some digging for you guys, they only pay out about 60% of their profits in the form of dividends. So I actually can place a safe stamp on this one. All right, hungry investors, you made it this far. Here is what I look for in a good value stock in order of importance. PE ratio, this is the best known stock valuation metric on Wall Street, and for good reason. The price to earnings, or PE ratio, is available for most companies as long as they make a profit, and you can compare the price to earnings of one stock and another stock that are both profitable super easily. To calculate it, simply divide a company's stock price by its last 12 months of earnings. Now you can see what is cheaper, Procter & Gamble or Johnson & Johnson. They are very close, so you have more homework to do, but compare that and Kodak. You know Kodak is PEG ratio. This is similar to the PE ratio, but adjusts to level the playing field between companies that might be growing at a slightly different rate and companies that are growing at a slower rate. It stands for price to earnings growth. By dividing a company's PE ratio by its annualized earnings growth rate, you get a more coconuts to coconuts view of two stocks being compared. This is a metric that you can find on the Statistics tab in Yahoo Finance. Price to book ratio, think of the book value as what would be theoretically left if the company ceased operations and sold all of its assets. A low price to book ratio means high safety, and a high price to book ratio means low safety. See how that worked there? This is in a lot of books, especially tied to Warren Buffett. I'm linking to in my description. He uses it very widely because it can give an investor lots of information when it comes to making a good decision. All right, my awesome YouTube family, like the smash button, drop a comment for your boy, and you know what the deal is. Be aggressive in learning, but be safe in investing, and have a good weekend. I love you all.